What if you could send money anywhere in the world instantly without a bank getting in the way? And what if you didn't have to worry about the price suddenly dropping to zero overnight? Well, that's the big promise of stablecoins. And today, we're going to dig in and see if they actually live up to the hype.
So, here's the big question, right? How do you actually create a dollar that can live on the internet? A dollar that you can send around like an email, but one that doesn't have those absolutely wild price swings you see with other cryptocurrencies. That's the puzzle that stablecoins are trying to solve.
Okay, so at its core, a stablecoin is basically a crypto token with an anchor. Think of it like a ship in a stormy sea. That anchor is usually tied to something really stable, like the US dollar. Its whole job is to stop the token's value from flying all over the place. The goal is super simple. One stablecoin should always be worth $1. That's the dream.
All right, let's get into it. Think of this as a stablecoin showdown. We're going to look at the three biggest players in the game. First, there's Tether, kind of the controversial king of the hill. Then you've got USDC, the squeaky clean challenger, and finally Dai, the decentralized idealist. By the end of this, you'll see exactly how they're different and understand the really important trade-offs you have to make when you choose one.
So, first up, we've got Tether, or USDT. This one is the undisputed king of stablecoins. I mean, it's the OG, the biggest one out there, and oh boy, is it controversial. To give you a sense of just how massive it is, listen to this. On any given day, more money moves through Tether than through most of the world's biggest banks. That's huge.
Yeah, it's really hard to overstate just how influential Tether is. It is the most traded stablecoin, period. It's pretty much the lifeblood of the entire crypto market. Because it was the first big one, it created this massive network effect. You know what I mean? It's like everyone uses it because everyone else is already using it. That makes it incredibly tough for any newcomers to even get a foot in the door.
So Tether's promise was always super simple. For every one USDT coin, there's one US dollar sitting safely in a bank account. Simple, right? But for years, there's been this big cloud of doubt hanging over that claim. The question that just won't go away is, what's really backing it? What's actually in the vault?
And this is where it gets crazy. The bombshell dropped when regulators found out that Tether wasn't just holding cash. Nope, its reserves were this cocktail of different assets. And some of them, like commercial paper and loans, were, let's just say, not exactly cash. This created a huge, terrifying risk. I mean, what if there was a panic? What if everyone tried to cash out their Tether for dollars at the same time? Would they even have the money, or would the whole system just collapse?
Okay, so all of this controversy around Tether, it created a massive opening in the market for a competitor. And right into that gap stepped USDC, or USD Coin. It was built on a totally different idea, a completely different philosophy, radical, absolute transparency.
And you can just see the difference right here. It's night and day. On one side, you've got Tether's mystery box of complicated assets. But on the other side, you have USDC, and its reserves are crystal clear. What's in there? Just two things, cash and short-term US government securities. That's it. It's really the difference between a total black box and a completely open book.
See, USDC is all about playing by the book. It was founded by major US players like Circle and Coinbase. It's registered as a money services business here in the US. The reserves? They're held in regulated American financial institutions. And the best part? A major accounting firm audits them every single month, and they publish the reports for everyone to see. This obsession with transparency and compliance is exactly why it's become the go-to stablecoin for big businesses and institutions that just can't afford to mess around with risk.
Okay, so we've met the controversial king, and we've met the clean-cut challenger. But now it's time for the rebel. Meet Dai. Dai is a totally different beast. There's no company running it, there are no dollars sitting in a bank backing it, and there's no single person or group in control. It's a truly decentralized currency.
So you're probably asking, how on earth does that work? Well, instead of being backed by dollars in a bank, Dai is backed by other cryptocurrencies, like Ethereum, that get locked up in a special smart contract, basically a digital vault on the blockchain. The key thing here is that this whole system is run by code, by a computer program, not a company. It's all automated and totally transparent for anyone to look at. The easiest way to think about it is like a decentralized crypto pawn shop. You take some of your own crypto, say Ethereum, and you lock it up in one of these smart contract vaults as collateral. Once it's locked, the system lets you generate or mint brand new Dai as a loan against it. And because this whole thing is just code running on a blockchain, it's open for anyone to use, anywhere in the world, no permission needed. So if there's no company, who's in charge? Who makes the rules? Well, the users are. Dai is governed by something called a DAO, a decentralized autonomous organization. Basically, it's a global community of people who hold a special governance token, and they get to vote on everything. The interest rates, what collateral is allowed, all of it. This structure is what makes Dai so powerful. It's censorship-resistant. No single company or government can step in and freeze your funds or shut the system down. And that is why it's such a cornerstone of DeFi, or decentralized finance.
Okay, so there you have it. 3 very different stablecoins, each with a totally different philosophy behind it. You've got Tether, USDC, and Dai. So which one is the best? Well, it's not that simple. It really depends on what you value most, because choosing one means accepting a pretty specific set of trade-offs. Let's just break it down really clearly. If you go with Tether, you're getting access to the deepest liquidity in all of crypto. It's everywhere. But you have to be okay with the risk that comes from not really knowing what's in their reserves. Now, if you choose USDC, you get incredible transparency and regulatory compliance. You can sleep well at night knowing it's backed by safe assets. But you're placing your trust in a centralized company and the US banking system. And finally, with Dai, you get true decentralization, freedom, censorship resistance. But you're taking on different kinds of risks, like the complexity of the system and potential bugs in the smart contract code.
And really, this all boils down to one fundamental question. What do we want the future of money to be built on? Do we put our trust in companies bound by regulations and auditors? Or do we put our trust in code, in transparent, open-source systems that anyone can verify? There's no easy answer, but the choice we make will fundamentally shape the future of finance and the internet itself. And believe me, this debate is really just getting started.